The subject matter for this presentation is step number 8 of the accounting cycle, which is closing entries are journalized and posted. For accounting purposes, what is the closing procedure? What do we mean by closing procedure? Simply put, closing refers to transfer. Ano yung tina-transfer? We are actually transferring balances from one account to another. In the closing procedure, we are transferring temporary accounts to permanent accounts. Temporary accounts are sometimes referred to as nominal accounts, and permanent accounts are sometimes referred to as real accounts. Permanent accounts are the balance sheet accounts, and temporary accounts are the income statement accounts. Let's discuss into details what are the temporary accounts. As I've mentioned earlier, temporary accounts are the income statement accounts. It also includes withdrawal accounts. What is the idea of temporary accounts? Income, expense, and withdrawal accounts are temporary accounts that accumulate information related to a specific accounting period. Meaning, if you, for example, accumulate 100,000 of revenue for 2019, the said 100,000 is specifically related to 2019. Come 2020, new record will be made. And let us say, on 2020, you earn a revenue of 150,000. The said 150,000 is related specifically only to 2020. For the 2 years, you actually accumulate a 250,000 amount of revenue. But for purposes of reporting to your financial statements, the 100,000 is to be presented in 2019, and the 150,000 is to be presented in 2020. So in order for us to have a new start, to have a new record for 2020, we have to close this 100,000 specifically related to 2019. Unlike permanent accounts, let's have a little discussion about permanent accounts here. An example of permanent accounts are the balance sheet accounts. To be specific, let's try an asset account. If in 2019, you have a cash of 100,000, to be specific, December 31 of 2019, come 2020, January 1 of 2020, your cash will be 100,000. Why? Because permanent accounts are not being closed. So it is an accumulated value. Unlike temporary accounts, let us say December 31, 2019, your revenue is 100,000. When you start your January 1, 2020, your revenue is actually 0. Why? Because you close your December 31, 2019 revenue account. Why? Because revenue is an example of temporary accounts, and temporary accounts are being closed. How are you going to close temporary accounts? First, let's discuss closing the income accounts. Let's have a little recap. Income is an income statement account. As an income statement account and as an income, the normal balance is credit. So how are you going to close the value? For example, in a previous example, the revenue has a balance of 100,000 at the end of 2019. The idea of closing is to make the balance 0. So if the normal balance of an income is a credit, this 100,000 is actually a credit. In order to close it and to make it 0, the revenue account will be debited. By how much? By 100,000. And where are we going to close the revenue account? As I've mentioned earlier, closing procedure is actually transferring transferring the balance of one account to another account. For purposes of closing, we will use another temporary accounts income summary. 100,000. Please take note of the income summary account here. On the other hand, how are you going to close the expense accounts? Expense is again an income statement account. The normal balance of an expense account is debit. Let us assume that the value of your expense account is 70,000. So since this is a debit, in order to make it 0, in order to close the expense accounts, what you're going to do is to credit it. By how much? 70,000. Again, closing procedure is transferring the balance of one account to another account. And where are we going to transfer the 70,000? In closing the expense accounts, we will use the temporary accounts income summary. you will debit it for 70,000. If you will recall, income summary is being credited here to close a revenue account, and income summary had been debited on this to close an expense account. As I've mentioned, income summary account is actually a temporary account. As a temporary account, we need to close it. Going back to our previous example, if we will make a T account of your income summary account, you initially credited it for 100,000 and debited it for 70,000. You credit it for 100,000 when you close the revenue account, and you debit it for 70,000 when you close the expense account. Following our T account here, the balance of your income summary account is a credit of 30,000. So this is a credit. And since income summary account is also a temporary account, we have to close it to another account. And in terms of closing, we will close it to a permanent account. So how are we going to make the income summary account balance 0? So since its balance is a credit of 30,000, in order to close this, we have to make a debit entry on income summary. For how much? 30,000. Where are we going to close the income summary account? We will close it in the capital account. For how much? 30,000. In this case, the capital account is a permanent account. Therefore, there is no need to close it to another account. Lastly, our closing the withdrawal account. Well, withdrawal account is part of our equity. And this kind of account is being closed directly to capital account. So withdrawal account, the normal balance of withdrawal account is debit. So in order to close it, you will credit it. So let us say the value is 10,000. And where are we going to close it? Directly to capital account. So capital account will be debited for 10,000. So as a summary, there are 4 accounts being closed. Number 1 is income. Number 2 is expense. Number 3 is income summary. Number 4 is withdrawals. Income and expense are being closed to income summary account. Which is this. Income summary is being closed to capital account. Withdrawals is being closed to capital account. So we can sum it up that income, expense, and withdrawals, which are considered to be temporary accounts, including the income summary account, is being close to capital account. And if we will recall, actually, the capital account is an owner's equity account, and the components of this are actually the income, the expense, and the withdrawals. That's why when you make your financial statements, only the ending financial statements, particularly the balance sheet, only the ending capital account balance is present.